Let's immerse ourselves in the dynamic realm of stocks, where May 2024 is promising a rollercoaster ride of exciting picks and kicks. You may be pondering, what exactly are these so-called picks and kicks? In the exhilarating world of the stock market, picks and kicks are more than just jargons. Picks are essentially those stocks that are not just flexing their muscles, but are also setting the stage on fire with their impressive performance. These are the stocks that have gone beyond the ordinary in exceeding expectations and harbor immense potential for future growth. How do we identify these picks? This is where the play of market trends, economic indicators, and company performance come in. A stock becomes a pick when it consistently trends upward, outperforming its peers and the market average. It's not just about the numbers, but the overall health of the company too. A strong balance sheet, robust revenue growth, and a visionary leadership team can further strengthen a stock's status as a pick. On the flip side, kicks are those stocks that have tripped and tumbled. They've either plummeted in value or have shown a disappointing performance. These are the stocks that have failed to keep pace with the market or their sector growth. Economic indicators such as a slow GDP growth, high inflation, or a bearish market trend can push a stock into the kick zone. But be cautious. Company-specific issues like poor financial performance, negative earnings reports, or lack of innovation can also contribute to a stock becoming a kick. But remember, the world of stocks is all about perspective. One man's kick can be another man's pick. What counts as a loss for one can be an opportunity for another. Your perception, your risk tolerance, and your investment strategy shape your playground in the stock market. Every pick and kick has a story to tell, and understanding these stories is what makes you a savvy investor. Fasten your seatbelts, everyone. Amazon shares have been hitting the gym hard, boasting a laudable gain of nearly 2%. What's behind this muscular performance? A combination of factors, from its vast online retail operations to a booming cloud computing division and a growing advertising business. This e-commerce titan recently reported earnings of 98 cents per share on a staggering revenue of $143.31 billion, significantly exceeding analysts' predictions. This was not just a fluke. It's a testament to Amazon's diverse and efficient business model. Taking a closer look, one can see that the company's advertising and Amazon Web Services, AWS divisions, significantly exceeded expectations. These two sectors have become key pillars of Amazon's revenue model, further solidifying Amazon's status as a diversified colossus. But how does Amazon stack up against its competitors? Well, let's just say it's more than holding its own. While other tech giants such as Google and Facebook also reported strong earnings, Amazon's breadth of services and products sets it apart. However, it's important to keep in balance that Amazon's second quarter revenue forecast slightly missed the target. A reminder that even the biggest players aren't immune to market volatility. Regardless of this minor stumble, the company's overall health remains solid and robust, backed by diverse revenue streams and a proven adaptability to market changes. Get ready for the storm. Starbucks shares have encountered a significant downturn, plummeting close to 10% in the after-hours trading. The iconic coffee behemoth, renowned for its enchanting frappuccinos and globally recognized green insignia, failed to meet the fiscal second quarter projections in terms of both revenue and earnings. This slump in Starbucks' performance serves as a stark reminder of the unpredictable and capricious character of the stock market. The reasons behind Starbucks' slip are multifaceted. Increased competition from local and international brands, coupled with rising operational costs, have strained the company's profits. The ongoing global pandemic has also played a critical role in dampening sales, as lockdowns and social distancing measures have resulted in fewer in the stores. In the face of these challenges, the company could deploy a slew of strategies to bounce back. For starters, diversifying their menu and incorporating healthier, sustainable options could attract a wider customer base. Besides, an increased focus on digital marketing and home deliveries could offset the decrease in in-store sales. The company could also explore untapped international markets where the demand for artisanal coffee is on the rise. To weather this storm, Starbucks needs to adapt and evolve. As we move ahead, we will be closely observing Starbucks' recovery arc, keenly watching if it can brew up a strategy to bring its stock back to a state of full-bodied robustness. Buckle up, dear listeners, because next we're diving into the world of Pinterest, the platform where creativity takes flight. This engaging social media platform recently saw a jaw-dropping increase in its shares by nearly 19% after an impressive earnings and revenue beat in the first quarter. Quite the financial feat, wouldn't you agree? But what's behind this meteoric rise? It's all down to Pinterest's clever capability to monetize user engagement. As it turns out, every scroll, click, and pin from its users translates into significant revenue for the company, a clear indication of the mounting influence social media platforms wield over our daily lives, whether we realize it or not. Pinterest's success didn't just happen by chance. It's a result of a well-thought-out strategy and a keen understanding of its user base. The platform has been constantly evolving, introducing new features and optimizing existing ones to keep its users engaged and advertisers satisfied. Furthermore, Pinterest's emphasis on e-commerce integration has played a significant role in its surge, providing seamless shopping experiences for its users. To maintain this upward trajectory, Pinterest has a clear game plan. The company is planning to invest heavily in improving its ad business, enhancing user experience, and expanding its international reach. This forward-thinking approach will not only help Pinterest to continue its financial success story, but also reinforce its position as a key player in the social media space. So, the influence of Pinterest on our lives, for better or worse, looks set to increase even further. In an unforeseen development, Supermicro Computer, a tech behemoth known for its superior server solutions, saw its shares take a plummet of nearly 8%. The company reported a fiscal third quarter earning of $3.85 billion, falling short of the consensus estimate of $3.95 billion, according to the data provided by LSEG. This shortfall in expected revenue could be attributed to a multitude of factors, such as competitive pressures, production issues, or even a shift in market trends. The details behind the reasons for the drop, however, remain opaque and under investigation. The fall in share value is a significant event in the tech industry, known for its unpredictable nature. It's not just a blow to Supermicro Computer's reputation, but it also spells potential trouble for the tech industry as a whole. The drastic drop in share value could lead to a loss of investor confidence, possibly triggering a domino effect on other tech stocks. It serves as a stark reminder of the inherent risks of the tech industry and the volatility it's known for. It emphasizes the crucial need for constant innovation, adaptability, and astute financial management within the sector. Our third selection for the month is none other than the streaming titan Netflix, which is making strategic power moves that are worth noting. Netflix recently announced a groundbreaking deal with TKO Group Holdings, a decision that isn't merely a new business venture, but a noteworthy paradigm shift. This partnership is poised to revolutionize the face of entertainment as we know it. TKO Group Holdings, a leading player in the entertainment industry, is known for its impressive portfolio of services. Its collaboration with Netflix means more than just new shows. Or it's about potentially changing the rules of the game, setting new standards, and redefining how we consume entertainment. Imagine a world where Netflix doesn't just provide you with movies and series, but becomes a comprehensive hub for all forms of entertainment. That's the potential this deal holds. But the surprises don't end there. Netflix is also stepping into the boxing ring. They plan to broadcast a much-anticipated live boxing clash between Jake Paul and Mike Tyson come July 20th. This bold move signifies Netflix's ambition to diversify its content beyond the conventional. Stepping into the realm of live entertainment, it's a clear testament to Netflix's dedication to their reach and offering a wider variety of content to their viewers. So what does this mean for Netflix's, despite appearing to be stretched beyond its 5% buy zone following its recent breakout? It's crucial to bear in mind that stocks are not static. Netflix's bold strides into new territories could very well lead to significant capital appreciation in the long run, making it a potential golden egg in any investment portfolio. However, as always, it's vital to keep an eye on the market and make informed decisions. In an unforeseen turn of events, finally on our rundown of stock market movements, we see Caesars Entertainment facing a significant setback, with a loss around 3%. This translates to a considerable dip in their market value. This sudden decrease underlines the inherent perils tied to casino stocks, drawing our attention to the fact that, akin to a spin of the roulette wheel or a roll of the dice at a craps table, there's always a degree of unpredictability. A variety of factors can result in such sudden drops. Changes in gambling regulations, shifts in public sentiment, or unexpected global events can all have devastating impacts on casino stocks. However, it's noteworthy to mention that the inherent volatility of casino stocks, including those of industry giants like Caesars Entertainment, can sometimes pave way for a roller coaster-like investment journey. For thrill-seeking investors, this volatility may not only provide a rush of excitement, but also potential high returns on investment when the odds turn out to be in their favor. As we wrap up this exhilarating journey, remember that market trends and stock movements are always in flux. Today's dialogue provides a cursory overview of the current market dynamics, a glimpse into the wax and wane of the stock market. Much like the sea, it's incessantly stirring. This discourse is purely just that, a discourse. It's not a financial advisory nor a wealth-building blueprint. It's a launchpad for your personal exploration. In the rush of the stock market, the importance of research cannot be overstated. Scrutinize the companies, understand their financial stability, their strategic plans, and the markets they operate in. Observe the market trends and arm yourself with information. Informed decisions are your strongest weapons in this battlefield. And remember, in the thrilling game of stocks, a sure bet is a myth.